So we're going to look at a flexible budget here for the Yellow Bag Company. And whenever we look at a flexible budget, we have to have a master budget. So here's a master budget, pro forma income statement and contribution margin format compared to actuals. The variance indicates the difference between what was budgeted and what actually happened. And here's a column to determine whether an item is favorable or unfavorable. So the purpose of a flexible budget is to look at various activity levels, but also to eliminate sales volume as a variance. So for example, here we can look at these variances from the master budget, but we don't know if they're because of some other factor or because of the difference in sales, where sales was actually less than we anticipated. So if we go down to a flexible budget, we can compare it to the actual amounts. And here's the actual amounts, just copied from up here. So the first thing we want to do is we're going to make some assumptions here. We're going to assume that fixed expenses have no variance. So we're going to assume that our fixed expenses are the same as anticipated. And fixed expenses, of course, are easier to predict anyway because they're not based on volume. So we're going to assume there's no variance for fixed costs. We're also going to assume that our sales price was accurate in the budget. So basically, we're going to say that we have 8,200 units. And again, this is one of the purposes of a flexible budget, to eliminate sales volume as a variance. And we're going to assume that we stuck to the sales price we had in the budget. So we're going to say that our sales are 106,600. Now, what we want to do is focus on the variable costs. So we're going to use what we call a budget formula. Your book calls it a standard cost, in order to figure out what these items should be at this flexible budget level of 8,200, which is the actual amount. Okay, and we have to use the master budget in order to do that. So to figure out our direct labor budget formula, okay, we're going to take our master budget direct labor costs, or expected direct labor costs, and divide it by the expected units. So we're going to come up with $4 per unit. For direct materials, we would do the same. We're going to take our direct materials cost estimated in the master budget divided by the units, and it's going to give us $2 per unit. We would do the same for power. So these are all variable costs. So we're going to take the 5,000 that was anticipated in the master budget and divide it by the units. And then finally, the variable payroll, the same. So basically what we're doing is we're saying these are the costs that were standardized in the master budget, and this is what we have to use in the flexible budget. Okay. So in order to get our flexible budget at actual activity level, in other words, if we were doing the master budget at the actual activity level, let's see what we come up with. So we're going to take the units, the actual units, times the direct labor per unit in the master budget, and we have 32.8. So we're a little bit higher in the actual. Let's do the same for direct material. So direct materials, we were way off, right? Likely due to costs that might have been out of our control. For power, okay, again, we're very low. So either we underestimated these costs or something happened internally or externally to change them. But this helps us plan for the next year by doing a flexible budget like this. Okay, So our variable payroll was lower than anticipated as well. So if we add up our total variable costs, and then we get our budgeted contribution margin, so our contribution margin was budgeted to be much higher than it is. Okay. And so our operating revenue was 19,000. The actual was only 1120. So we have to relook at this when we budget for the next year. Now, variance is simply the difference between the actual amount and the budgeted amount. And we usually don't do negatives with variances. So we would just take the higher number minus the lower for each of these. So these variances, except for variable payroll, okay, definitely appear to be unfavorable. And these we don't need to do because they're the same. So what this tells us is that we have a difference, and perhaps it will help us budget better next year. But we can see here that our direct labor variance is unfavorable because it is higher than what we budgeted for. So that's an unfavorable variance. Our direct material is also unfavorable, as the budgeted amount is much lower than the actual amount. And we have the same issue with the power. Now with the variable payroll, our actual amount actually came in under the budgeted amount, so that's a favorable variance. Now with the totals, we can do them or not do them. We can certainly see that the actual total variable costs were higher than the budgeted amount, so that's going to be unfavorable. And we can see the same thing, our actual contribution margin was much lower than the budgeted amount, so that's also unfavorable. As is our operating revenue. Okay. So that's a basic flexible budget, and what we'll do in the next video is we'll take a look at what's called management by exception. When do we investigate? Thank you for your attention.